Hi everyone, it's Alex here at Sestry Capital Research. Welcome to our Inner Circle webinar. It's currently Monday, the 11th of December, 5 o'clock Eastern for the benefit of the tape. Okay, I wanted to do one thing and one thing only really on today's webinar, and that's to walk folks through how I think the best can be gained from this Inner Circle service. And the reason to do that is twofold really. One, we've had a lot of new joiners since the last time we ran this sort of session, so welcome all. And secondly, I think the service is almost a year old now, starting to get into its stride. And speaking personally, using pretty much the methods that we publish in the service and the ideas we publish in the service, the results have been pretty good for me. And so I want to make sure that people at least understand how the service works, how to capture the ideas and use them if you choose. Obviously, everyone here does their own thing, but at least so that people understand what we're doing, what we're publishing, what we mean by what we say, and so on and so forth. So I'm going to run through each aspect of the service and take questions all the way through as usual. And at the end, and best way to get your questions across, twofold. Either one, unmute yourself and shout into the system. So I'm just going to make sure everyone can do that. 1 second. And then the other thing you can do is post questions in the Slack channel. Use the main Inner Circle channel. I can see questions there and read them out for everyone's benefit. Okay, before we do any of that, let's do our standard disclaimer, which is on your screen right now. So this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or a solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Sestry Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Sestry Capital Research. Sestry Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's first of all get the service website on the screen and we'll step through it. Okay, so there's a number of aspects to the service and places to find resources. Where you should always go if you're looking for something is go to sestrycapitalresearch.com. This is the screen you'll see. And this has a number of the more common posts on the market for the open post each day, portfolio earnings, those sorts of things, the occasional expert series link. And it also has across the top the various different aspects of the service. So equity indices here, come on to that in a moment, single stock and ETF analyses here, portfolios here, reviews here, about here, real time here. We'll come on to those in a minute. The main thing I want to talk about today is equity indices, portfolios, and the stocks and ETFs tab. Okay, first up, equity indices. So the notion we have in the service here is very simple, which is what we're trying to do is work out a way to invest in US equity indices in a way which is market neutral. In other words, how can we do it that can be profitable in both bull and bear markets? Now, it's been a bull market pretty much all year, 2023. In some ways, you could say, well, this has been an easy ride for our picks. Well, it has, but on the other hand, you'd say that we caught the bull market correctly and caught its low pretty nicely as well, and we've yet to bail out. Speaking personally, during the run up from March to July, had a couple of two big short positions, which hurt me a little bit. And then in the run down from July to October, had some two big long positions, which hurt me on an unrealized basis a little bit. But overall, been an excellent year. So just to rehash what we're trying to do here, what you see on your screen here is an idealized wave path and set of Fibonacci extensions and retracements. Now, this can work for any liquid stock, but here we're talking about the indices. So let's think about the S&P. It's true for the NASDAQ as well. So think about the S&P. This here is a bullish cycle a 5 waves up cycle, 1 up, 2 down, 3 up, 4 down, 5 up. And if we're in a bear market, you could point that wave downwards and you get 5 waves pointing down. And so the idea is, well, you can either trade very frequently, very short term, and we'll come on to that in a moment, or you can try to ride the dominant wave without doing too much at all. And when that wave switches in a sub-wave moment, then try to hedge in the other direction. So in short, what we're trying to do in the service is take 2023, bull market, we said. And we said the dominant trend we thought would be up. And so if you look at this chart, let's imagine this is the S&P in 2023. So it starts out over here at the lows in January, let's say, moved up in, this basically is the S&P. So this was January, February, March, July, October, November, and probably end of December. So how would you try to profit from this? Well, you could either just hold SPY or any other S&P ETF and do nothing from January the 1st to, let's say, December the 31st, and that would be just fine. Alternatively, though, what we try to do in the service is how can you accelerate those returns without taking extra risk on the underlying asset? So instead of having to chase, crypto or options or something else wacky, could you use the S&P itself to get better returns? And we think you can. We think that, first of all, on the long side, you can use the leveraged ETFs. You can pick 2 or 3 times leveraged ETFs. We use the 3 times. So for the S&P, we use UPRO, UPRO, but you could use SPXL to achieve the same thing. Different fund manager, but the same goal. And if you were to hold UPRO from the 1st of January to the 31st of December, let's say, I'm assuming it goes up for the rest of the year, but even if it's sort of flat from now, then you would achieve much better returns than if you just held SPY, albeit at the expense of some pretty painful drawdowns. The question is, can you solve for those drawdowns? And we think you can. We think that if you had perfect timing, here's what you would do. You would, again, perfect timing. No one has this. No one is this good. But if you had perfect timing, you would hold UPRO from this 0 point here to this wave 1 high. And if you knew for sure that was a wave 1 high, you'd sell all of your UPRO and you'd buy SPXU, which is an inverse 3 times S&P instrument. And you'd ride that down to the wave 2 low. And if you knew for sure that that was a wave 2 low at the time, you'd say, well, I'll sell all my SPXU now, cash all the profits, thank you very much, and I'll buy UPRO and ride it up to this wave 3 high. And because I am one of the many gods almighty, then I will know for sure that this is a wave 3 high, and I'll sell all my UPRO now. And then I'll buy SPXU and ride it down to wave 4, and again, with perfect vision, sell it perfectly, buy UPRO, and ride it up here. And you would do stupendously well. Now, of course, the downside with that is no one knows at the time what's a wave 1 high or a 2 low or a 3 high or 4 blah, blah, blah. You can measure these things, but some things are easier to measure than others. Measuring a wave 1 high, you can only do in retrospect. Measuring a wave 2 low, that's a bit easier because you're measuring the drop versus what was obviously a 1 high. Where measuring a 3 high is a bit easier because you can measure the distance from the 2 low to the 3 up relative to that 1 high. And measuring a 4 down, well, you can measure it relative to that 1 high. And a 5 up, you can measure it according to how far 5 ups typically stretch. But a 1 high, impossible. You can't know. And because you can't know, and frankly, you also can't really know with precision the 2 low and the 3 up and the 4 and so on. And also because emotion gets in the way. Right? So if the market's going against you, it's very difficult to think clearly. What we think is a great idea in the service is to use hedging. And hedging means many things, but in this strategy, very, very simple. This is the idea. Let's say we're in a bull market, and I think we are. So in 2023, if you didn't and couldn't have known exactly where the market turns were, what you could have done was this. Own UPRO from down here. When it started to look like the market was rolling over in the first quarter, buy some SPXU. Probably not a huge amount. Up here you'll be thinking, well, it might just be a dip, it'll carry on. If you load up on SPXU and the market rips up, then it's going to cost you money. But if you added a little bit here, and then as the market fell, you added a bit more and a bit more, and then as the market stopped going down quite so fast, you started to maybe sell some of that SPXU and take profits. And in particular, if you then took the profits from the short side and used that to buy additional units in UPRO down here, well then in the way 3 up, your UPRO is going to rip. And on the way up here, you might be all out of the SPXU or not have much left. And then you might repeat that all over again up here. So when the market starts to roll over, you might start to add a little SPXU here and here, sell it somewhere around here. Again, never perfectly. Use your profits in SPXU to buy more UPRO around here and ride it to the top. Now, in that example, you've never sold your long position. So you could argue correctly that had you had perfect timing, you would have done better. That's right. But I'm working on the assumption here that we're all humans and we don't have perfect timing. Even machines can't time this perfectly. Whereas if you think I'm in a bull market, well, the dominant leg is long. So I'm going to pick my long instrument in the S&P. I'm going to call it UPRO, and I'm just going to hold that. And every time I see a counter trend down, I'm going to buy some SPXU, and I'm going to cash in the SPXU gain when I see a low, and I'm going to use that to buy some more UPRO. And I'm going to use that to compound up my UPRO gains because I'm getting free money from the profit that occurs on the way down. I'm going to cash in that free money, and with the extra money I've got, the profit, not the original capital used for SPXU, but the profit, then I can use that to buy additional units of the long side UPRO for nothing, effectively, because that money's free. I got it on the way down, and I'm going to have additional units, therefore, to ride up. And the same would work with the NASDAQ and the instruments you could use. You could do it unlevered with QQQ for the long side. I can't remember there's an unlevered inverse. I can't remember the name of the ETF, but there is a 1 times. You can do it with a T 2 times, or like us, you can do it 3 times with a T triple Q long and an S triple Q short. The Dow and the Russell can be done like this. They're a bit trickier, in my opinion. And if I were going to implement a pure play version of this, I personally would probably only do it with the S&P and the NASDAQ, because although it can be done with other ETFs, they don't chart as neatly to waves and fibs, and the likely error is higher. In addition, the S&P and the NASDAQ are underpinned by a wide range of rock solid securities issuers, and so the asset that lies beneath you can trust more so than any, in my opinion, instrument that's going to give you the same sorts of returns as the 3 times. So preference to, in my opinion, crypto or options, all those sorts of things. Okay, so that is the theoretical strategy that we propose in this service for the index ETFs. And you'll see the trade disclosure alerts you see are basically me pursuing that strategy, imperfectly, as you will see, on account of being, human and prone to all the same sorts of errors that everyone else is. But nonetheless, that's worked out pretty good for me this year. Very, very, very well in the NASDAQ, which I bought this is a great example. You can use the hedging strategy to correct for being wrong. This is the real value of it. So I bought too much TQQQ in August last year, 2022, which turned out to be a spike high. It then sold off pretty heavily, but I managed to get some gains with SQQQ on the way down. I held the TQQQ all the way along, and when the NASDAQ sold off down into the October lows this year, 23, what had been a pretty huge profit on it came down markedly, but I felt good that it would ride up again, which it has, and so I'm sort of sat here at the end of 2023 looking at a nice, tidy, unrealized gain in TQQQ, which I don't plan to sell anytime soon. The same could have been done with the S&P with UPRO, and again, it can be done with the NASDAQ and the Russell, but my own personal view is stick to the NASDAQ and the S&P for this strategy. Okay, that's equity indices. Now, if you also want to trade equity indices in a higher frequency way, we now have 2 ways for you to do so. So if you go to the site, click real time. Try again. Okay, here we go. So real time, we now have, as you may know, 2 folks running real-time trading services for us, and they're both equity index focused. There's some other stuff in there as well, but We have Tuvok Van and Gaines, who both will provide you setups whereby you can do all the things I've just talked about, but in a much shorter time frame. So the time frames I work to are typically weeks and months. And that's in part because it's what I'm comfortable with, and in part because I just don't have the time to sit trading all day. I have other things to do. And if you also have other things to do, then maybe those time frames are good for you. But a fantastic way to make, or try to make even more money from the equity indices alone, again, based on rock solid securities issuers, nothing weird, is to do all the things I've just talked about in one account on a weeks and months time frame. And then look at these channels here. So this is Van's channel. These work in Slack if you haven't seen them. This is Gaines's channel. And you could work with those as well to trade very short term. So typically some intraday movements, some multiple day movements. And you could be doing that in a completely separate account. So you get to play the S&P over a long time frame and also over a short time frame. And the beauty of that, in my opinion, is, again, you're using rock solid underlying assets. Whether you are trading with the inner circle strategy and or with the strategies used by these guys in their real-time channels, then the hedging method is there to help you manage your risk, manage downside risk, manage potential losses, and also, in particular, if you get the hang of it, it's there to be able to make money on both sides of the market, whether the market's moving up or down. Okay, that's equity indices. Next thing I want to talk about is portfolios. So, on the portfolios tab right here. Now, the same thing I've just talked about, which is these waves and fibs. Another way we look at these sorts of movements of securities is so-called Wyckoff rotation. Now, this is, again, an idealized chart, as you can see. And this is a way of thinking about stock movements. It's not necessarily a real sort of documentary, or it's not reality TV, but it approximates to reality quite well. And again, this theory works the best for highly liquid stocks and ETFs, not so much for small caps. Now, the notion here is, and this is a theory invented by Mr. Wyckoff. Let me see, about 100 years or so ago. And his theory was this, which is, if you are a large account player, not a momentum hedge fund, not a big family office, but a really, really big player, a very large insurance company, a very, very large multi-manager hedge fund, and you want to pick up a position in, let's say, Microsoft. Well, you can't simply go out and buy Microsoft in one day, because you need to buy so much of it that you'll move the price. The market will be onto you and the price will move against you. No good at all. The smaller the company gets, the worse the problem gets. So let's say, okay, you decide that, well, I want to own just more than just Microsoft. I also want to own, let's say, Cloudflare, which is a single-digit billion-dollar enterprise value business, not very big, but you think it's got great growth prospects. You want some of that. And the minute you start buying that thing in bulk, the price is going to move against you. So what do? Well, you take your time. You go slowly. One of the disadvantages that very large account players have is that anything they do moves the price. And so the theory in Wyckoff rotation goes that they'll do everything they can to disguise what they're doing, because they don't want to see the price move until they're ready. So this theory goes that in the accumulation phase, you'll see a stock move pretty much sideways at the lows, as you see on this chart here. And this, the theory goes, is institutional accumulation. And sideways at the lows means typically in a range-bound fashion, as you see in this idealized schema here. Range-bound because when this Mr. Big sees the price rising up, they may choose to sell a little bit of their holding to trigger the market momentum to the downside. When it ends up at the bottom of their accumulation range, they may buy some more to start it moving up again. And as you'll have seen every day with the IWM chart that we post in the market on OpenNote, these things are real. There's a pretty good approximation to reality. Markup is when the big account has bought enough position, it's got all the exposure it wants, and then miraculously, by complete coincidence, you'll see that particular stock all over the financial news, Bloomberg, CNBC, everywhere else, with everyone with got great news stories about it. You saw it with Bitcoin last week. Bloomberg asking, well, should you be buying Bitcoin at 40K? They were not asking, should you be buying Bitcoin at 15K, which was only a few months ago, at all. In fact, at the time, the only stories they were posting were basically fear stories. But now, should you buy Bitcoin at 40K? That's a perfect example of markup behavior. Markup is where late money comes to play. Late buyers come in, and if you did your job well and you're accumulating at the lows, then this markup zone is free money, why it's called markup. Distribution, sideways at the highs. Okay, so this time frame could be hours, but the way we think about it, I think about it is this is months, possibly years, right? This is not short-term trading, although the same patterns can be seen in a fractal manner in short-term trading. But here, I'm talking about longer-term stuff. Distribution. So this is when a stock has run up. So let's say at the end of 2021, most tech stocks look like this. They moved sideways at the highs for a bit, and then they dropped into markdown. So markdown happens when big money has done selling. Usually retail has been buying at that level. Markdown happens, the price drops quickly because there's no more buyers. So volume is typically low. Big money's done dumping its stake, and you don't have people rushing in because big money isn't buying because they know the market's in a down cycle, and retail's too scared to buy. Retail's probably selling at this point, in fact. Okay, so this Wyckoff rotation we employ in each of the portfolio baskets that we formed, and so there's 4 so far. And the logic to them was simple in each case, which is at the particular point they were formed. So there's one in February, one in March, one in June, one in July this year, and none since then because there wasn't enough of a sell-off in October to want to form another one. And right now we're in a move up, so this doesn't seem to me to be a great loading the boat opportunity right now. That will come, so we'll form another one, but that's not today. What we did was we said, okay, this is to Friday's close, by the way. We said, okay, so in February, growth stocks are pretty much beaten up. And so let's form a core portfolio here that consists of growth E stocks. So in this core stock portfolio here, formed in 7th of February, if I recall correctly, we have Microsoft, Nvidia, L3Harris, Dynatrace, and Taiwan Semiconductor. So they lean growthy. L3Harris is a defense stock, value stock really, but it's a sort of growthy defense name. And that's done really well, as you can see, it's 60% up. And Nvidia has been the outperformer. Clearly, Microsoft has been no slouch either. And what we did here was the reason it's up so much versus the indices is we got this right. So we were paper buying these stocks in this accumulation phase, and then we did nothing. And then when markup happened, which really is still happening, other people have been rushing in to buy these, but in this portfolio, we'd done our buying already. So we'd finished, we did a one-shot buy in this portfolio on the 7th of February. No additions, no trim, nothing like that. This is just let it run. And the returns here are modeled on a total return basis. So there's not much dividend production in this portfolio, but any dividends that arise are reinvested, in other words, put back into the stock from which they came. No fee burden is applied here. It's not supposed to be a financial advisor chart. This is just what would your portfolio look like if you'd done this? Okay, so we also on the 17th of March said, well, look, the scary stuff, high beta software stocks, they are still really beaten up. So by March, some of the big cap techs had started to take off, but the smaller stuff hadn't. And we didn't time it perfectly, as you can see, it's the purple line. They dipped again in May, but not bad. So again, we said, back to this Wyckoff rotation, we said, well, let's try and accumulate some of these high beta stocks. So in here, you have, I'm going to get these wrong now, but MongoDB, MDB, CrowdStrike, CRWD, Cloudflare, NET, Zscaler, and one of those I can name escapes you right now. But same principle, high quality companies, stocks all beaten up, and we thought they'd run to the upside, which they have. So again, this one 62% up on a total return basis to Friday's close versus 29 for the Nasdaq, 19 for the S&P, 16 for the Dow, and just under 10 for the Russell. So pretty good. As the year went on, we did the same with financials. So the bank crisis was March, and bank stocks, financial stocks hadn't really recovered by June. But we thought, well, probably we're seeing some accumulation here at this point because everyone's terrified of owning banks. That means big money's probably going to buy them. Also, if rates come down, as they may do in 2024 or late 23, we supposed at the time, then that too can help lending and so forth. So in here you have Bank of New York Mellon, BlackRock, Citigroup, Bank of America, and another one whose name escapes me for now. So Chicago Mercantile Exchange, that's right. Up 14% total return basis, again, beating all the indices since then. Again, same principle, bought during the accumulation phase. Markup in financials is happening right now. So this portfolio, purple line, as you can see, sort of tracked the indices until about mid-November. Yeah, it's fine, but you could have done just as well by owning the S&P or the NASDAQ, for instance, and it's just started to break out now. So this is now, I think, in the markup zone. Now, if you look at our single stock analysis on each of these names, you'll see that they too are by and large in that markup zone. Finally, we looked at Dow laggards. We call this Dow tarts. So the idea is this is Dow component stocks that are lagging the Dow itself. We supposed that the Dow might be the first index to make a new all-time high, and it looks like that could be. And then we said, well, in the middle of the year, July, all the money's gone into big cap tech. Nobody's really looking at value stocks, so that must be a good time to consider accumulation. And so we went through and looked at which of the 30 names of the Dow components look good. They have to look good fundamentally, and they have to look good on the chart. And in here you have Nike, Home Depot, Intel, Dow Chemical, and one other. Of those, Intel's been the breakout by a country mile. Disney's the other one, and Disney's been the underperformer. But nonetheless, again, just started to break out. So this, again, you can see purple line did okay, underperformed the market really until October, November, it sort of tracked the market, and it's just started to break out. And again, you can see the down names now starting to break to the upside. So I think this now is markup zone. I would say the logic of this is folks looking at the Magnificent Seven and saying, well, that's run up a lot, where can I put some money? Dow hasn't, Dow stocks aren't looking overbought. I think I'll pile into there. So these are 4 portfolios which, had you followed them and bought them at the time, you'd be doing pretty well. We'll form more of these portfolios over time, but we're not going to suddenly set one up every quarter. We'll do that as and when the market offers the opportunity. There's been no real logic to sell these yet. That time may come, but it's not there yet. And so, we'll have done a good job if we basically follow this rotation strategy. So well done us. We seem to have bought quite well, certainly for the first 2 portfolios, maybe for the third and the fourth. Looks like probably on those, not definitely yet, but probably. The first 2 are in markup now. The second 2 are probably just starting markup. And the first 2 will probably enter distribution before the others. When that is, I don't know. Next month? I don't think so. 6 months, a year? I don't know. But we'll watch. And once they start to move sideways at the highs, I'm hopeful that we can call time and bank the gains on those. In terms of what this means in reality, I personally own almost all the stocks in these portfolios, and whenever I trade in them, you see alerts ahead of that trade. And I've also started to flag on a single stock basis if the buy is 5, 10, 20% up or whatever. And the reason to do that is just to give you a heads up, because you probably aren't following it as closely as I do. And I like to just say, well, this one's doing quite well. You might want to think about moving stops or adding or selling or whatever it might be. But I do that to help folks keep an eye on it. Okay, so that's portfolios. The next thing I want to talk about is single stocks and ETFs. Now, in here, this isn't very pretty, but it does work. Look on the stocks ETFs portfolio. Now, in here, what you see is there's a Google sheet. It's difficult to get Google Sheets to display particularly well in this web format, but it's okay. It does work. You can see, first of all, charts, single stock ratings, and my own positioning in these stocks, long, short, or none. First of all, grouped by those portfolios. There's the core, here's high beta, here's financials, here's Dow. And you can click on these charts. So for instance, we last updated Zscaler on the 28th of November after earnings. So if you click on that one, that will open the latest chart for you. You can see where we think Zscaler might be, where it is right now. They usually are, they're not real-time charts, unfortunately. It doesn't seem to be technically possible to do that yet. We've tried, but none of the chart providers can do it. So they are generally a little bit outdated. If you're desperate for a brand new one, always ask. Scroll down, and then you will then see all the sector ETFs that we cover. I'm in the process of refreshing these. So here's SMH, Semiconductor ETF, for instance. You can see what we think of that. And then all of the XL series are covered here. These charts are due an update, which will come through in the next day or two. Scroll down further, you then get to all the single name stocks we cover elsewhere in our work. So this Inner Circle service is our premium service. And although we don't talk about many of these stocks in the service, we do cover these elsewhere in our work for our Substack and Seeking Alpha services. And so you get the benefit of the charts here, of our ratings here, my own positioning in the stocks. That's all there. So that's tech all the way down there and defense and space down here. So there you have it. That's on the stocks and ETFs page. Now, one more thing before we finish up and go for questions if there are any, which is I want to show you the short-term ETF trading and just walk through that, which we will turn into a more formal part of the website in the new year. So, okay. So the idea here, and we've talked about this a few times, but I just want to go over it again because this is a low-stress way to try and do this. Okay, so this is our equity index strategy again. Okay, now, as I mentioned earlier, you can do this in a fast twitch, high stress way and sit and trade long, short all day for sure. And if you're good at that, fantastic. Don't forget to look at the gains and the van channels as a way to help you to do that well. Or you can take a slightly more sleepy approach, which is this method here. So this here is a model portfolio. And the idea was, well, we have a lot of subscribers here who don't have time to trade all day, but they can place trades at the open or the close. And so the notion here was, can we run a hedged portfolio using the 3 times levered ETFs in the NASDAQ, the S&P, and the Dow? And can we use it to try and beat the classic Warren Buffett, just own the S&P? And so far the answer is yes. Now we'll see what happens when the market rolls over and sells off. That's the time to deploy more shorts and try to catch that money on the downside, as we talked about earlier. But so far, so good. So just to walk you through how this has gone, we started on the 26th of September. It's now the 11th of December. We said, okay, call this a notional $1 million account at the opening. This would work for an account size of $100,000 for sure, just about $10,000 maybe. And it would work for $1 billion as well. It probably wouldn't work for 100 billion to move the market, but from anywhere between, let's say, 10,000 and $1 billion account, this would work. So the comparison group was take the $1 million, take the whole account and dump it all in SPY on day one, and then do nothing, right? You've got no cash left. This doesn't model dividends, by the way, so this would, all of it would move up a bit if we had dividends reinvested here. It's just a simple capital gain basis. So if you bought SPY on the day we opened this strategy, you'd now be just over 8 points up. Your IRR, your annualized return on that would be 46%, pretty good. And if you had $1 million at the start of the program, you'd have $1 million and 82,000 now, pretty good. You have no cash left. You deployed it all into SPY, and so if something goes wrong, you want to do something else, you need to sell some SPY and free up some cash. But that's the control group right there. Now, obviously, the market's been pretty strong, so that's 8% on the S&P in the course of 3 months, not bad. Over here, this is the current portfolio, which we built up over a couple of steps. There's been very, very little trading. So the most recent trade, for instance, was the 8th of November. Before that, the 6th of November. Before that, the 3rd of November, 26th of October, 18th of October. So this really is a low-stress way to invest and trade. And it's currently hedged on each of the indices, 7.6 to 1 on the NASDAQ, 7 to 1 on the S&P, 7.4 to 1 on the Dow. And so, as you can see, we have some unrealized small losses on the short side, so around $6,000 on each of the indices, and some unrealized pretty sizable gains on the long side, so between 40 and 47,000 on the long side. If and when the market rolls over, then we'll be adding to the short side here, averaging down our in cost on these things. And as you can see, the in cost on SQQQ is 18, now 15. So we hope to average those down and try to either exit these at break even on bigger volume, or maybe make a profit and roll that profit into the long side, as I mentioned earlier. But for now, this is where we stand. So on the overall account balance, 12.8% up, plays 8.3% up for the S&P, 78% IRR, plays 47% IRR. And again, if you'd started with $1 million, you now have $128,000 of profit versus $82,000 of profit in the S&P. And crucially, you still have a third of the account in cash. And why that's good is because this assumes no margin, no leverage, nothing like that. Simple cash account. And you've got a third of it left in cash. So that gives you the opportunity to do things. It gives you the opportunity to add shorts when the time comes. You could even add longs if you wanted to. And you would also be earning 3, 4, 5% on this cash, which is not modeled here, by the way. So in reality, if you were doing this, all of these returns would be a bit better. You'd be reinvesting dividends. You'd be earning something on the cash. Everything would be a bit up, but it's always better to model cautiously, in my view. So this has gone pretty well. We'll turn this into a live part of the website in January. You already get updates on this, where in Slack we'll say no plans trade at the open, no planned trades at the close, or we'll say at the close we're going to add so many units of TQQQ to bring total level position to 8 to 1 or 9 to 1 or whatever it might be. So we're already doing that in Slack, and we'll continue to do that in the new year. But this will feature on our website in the new year. So this is the third way to try to make money from this equity index strategy. So again, the reason to keep pointing to this is because the Nasdaq and the S&P in particular are broadly diversified, grade A star quality equity assets underneath the indices. And so if you can adopt a strategy without too much stress, you're churning in. 78% IRR probably isn't sustainable, but the S&P generally returns 8-9% IRR, 10% IRR each year on average. So if you can achieve even twice that without too much stress, and at the moment we're doing much better, but even 20% IRR without too much stress, that's pretty good. And in particular, if you can do it with plenty of cash left in the account, that's even better. And so what we have with the equity indices is we have a very long run strategy, which is to say own the long side, essentially forever, but hedge the short side. So whenever the market turns down in the short term, or like in 2022 over the course of a year, make money from the shorts, cash the shorts, take your profit, roll it back into the longs, because over the course of time, markets since the beginning of time have always gone up in the end. Could change tomorrow, but so far they've always gone up. So far the dominant leg ought always to be long. That's one route. The second route is this low intensity, low trading activity way to make money from the same thing. And the third way is to go onto our real-time services, again, real-time page here, which will walk you through Van and Gains channel, and you can use that to trade with more frequency and more intensity in those same equity indices. So again, let's go back to the start. So ways to make money from what's on offer in the service. You have US equity indices, you have portfolio strategies, 4 model portfolios so far with more to come, all of which are doing well, beating all market indices so far. That's pretty unusually good. I'm sure that won't be the case forever. We've had a good run, so well done us, but let's be realistic. And then single name stocks and ETFs that you can look at here as well. So that's Inner Circle so far. It's going to continue to expand next year. It's been our most successful service by a country mile, continues to grow really quickly. It's our most successful service that we've ever launched, and it's a lot of fun to run. I personally have benefited greatly from the work we do in the service, and so I'm hopeful that everyone here has too. If not, if you haven't found your way around the service, or you haven't sort of got to grips with how to implement the strategies here, it's not that any of these things are genius in nature. They're not, but if you use them well and correctly, then not only can you use them to try to profit from the approach, but each of them offer ways to protect the downside, to manage risk, to hedge, and so on. And so that's particularly important to me. I like to make sure that risk is controlled as well as the upside opportunities there. Okay, folks. So that's all I hope to cover today. So if we have questions, points, comments, anything, throw them at me now, or if not, we can do it in Slack later on. So anyone got anything to ask?
Hey Alex, this is
Hi, Jake.
JJ.
Hey, Jake.
Hey, yeah, I have a question. You know, a lot of the stocks that are in the portfolio that are covered have run up and are in markup, and I unfortunately have like cut my positions, selling too soon. So I'm in this odd point where I don't feel the conviction to go into any one of them that's currently in a hold,
Yeah.
and many of the accumulate stocks are just some of them are just dogs and not worth it in my opinion. So I'm just curious if you have any that you're pounding the table on that I could take a look
Yeah.
at.
Well,
Of course, not
personally,
recommending anything.
where I would go looking is where people aren't looking, right? So I've done a bit of what you say as well. So I'm out of Taiwan Semiconductor. So I did well with it, but I was a bit concerned about geopolitical risk. So I'm out. I'm out of Dynatrace, MongoDB, CrowdStrike. So I've done the same thing, and I did it where I didn't love the fundamentals. Okay, so Taiwan Semiconductor, I didn't love the sort of China Taiwan risk. Dynatrace, I thought growth was kind of slowing. MongoDB, there's not enough visibility in the revenue line for me, and CrowdStrike, you've got this odd combination of declining revenue growth and falling cash flow margin. So on a single stock basis, my view was I've made great gains in those. Thanks a lot. I'm gone. So I understand the situation, and I don't plan to go back into any of those stocks right now. Maybe in the future, but not right now. So I understand the situation. So if I was looking for where to put capital now, I would not be looking in this group. And it's not that they can't go up. I mean, of course, Microsoft could just keep going up. If the market's going to keep going up, so too will Microsoft. But I'd look at where people are not looking. So in this group, the one I probably would look at would be Zscaler, right? Because this is not a dog. It's not far out of its accumulation zone, and I think there's a good chance it can keep running. The fundamentals are superb. Cybersecurity is only going to go one way, and people have forgotten about this one. So I think this one can do quite well. I am very long Zscaler for disclosure. The other place I would look is go look at the Dow names and the financial names. Financials are just starting to break out, but they haven't all broken out. So if you look at the CME, for instance, okay, that's an ancient chart. Hang on a minute. It's an update. All right, let's just look at CME for a minute. Okay, so of the financials, CME is leading. Um, I personally think this can go higher. This is it's in market for sure, but uh, we're not even at the zero point 0.5 extension of that wave one. So I think it's got plenty to go. And if you to dig deeper into the more traditional financials, Bank of America just started to break out. Uh, Bank of New York just started to break out. Blackstone, has been in and out of accumulation, just starting to break out. Citigroup, still in accumulation. And my own view is these are all rock solid companies, not going anywhere anytime soon, and the stocks have yet to break to the upside. The other place I would look then, so that's financials, and then I'd look at the down names. So let's look at uh, Disney. Let's look at a live chart for a second. Here it is. So here's Disney. If you look at the earnings report on Disney, you know, I must admit, until I actually went and did the work on, I'd assumed that Disney earnings were going to be awful, and the stock was sort of, a bit of a dog, as you say. But it isn't. So have a look, right? So if you go on to where we go, homepage, portfolio stock picks, Disney earnings review. Here we go. It's not in bad shape. So revenue growth just started to accelerate. EBITDA margin's pretty good. Cash flow margin's pretty good. Leverage is down. Valuation, that's not expensive. And then if you look at the chart, pretty good, right? Accumulation, so sideways at the lows, not exciting. The whole point of this method is it's not exciting if you do it right. You may have to wait 3 months, 6 months, a year. So if you're looking for quick momentum trades, this isn't it. But long-term accumulators, I think this method works pretty well. Let's go back and look at what else we have in the Dow. So we've got Dow Chemical, Home Depot, Intel, Nike. Let's have a look at those. Dow Chemical, still in accumulation, still sideways. Intel, breaking out now. Yeah, okay, Intel breaking out. I mean, if you look at Intel, if you zoom in, that's probably going to come back down again at some point. So that may give you an opportunity to get in lower. It's fair rocketed away the last couple of months. Nike, weekly, just starting to break it. So, if something's left the accumulation zone, then it doesn't mean that it's gone forever. A momentum investor would now be getting excited about that. They'd say, well, that's a breakout stock. And they'll be concerned about a failed breakout where it will roll over and come back into this zone. So it depends on your time frames. If you want to play the accumulation game, there's a few opportunities here. If you're looking for a momentum play, you can find them here. I would tend to agree, which is, would you be buying, MongoDB here? Personally, no, because I think the stocks run up a lot, and I think the fundamentals are not great. Would you be buying CrowdStrike here? Personally, no. Same reason. And also, it's been only up since January, right? Not really any pullback. So even if you love CrowdStrike, at some point you'll probably get an opportunity to buy on a pullback, would be my assumption. So I absolutely sympathize with the situation. I think just go looking where people are. That's what to do.
Thank you.
Welcome. Hope that's helpful. Anyone else got anything, folks? Okay, well, let's finish up for today. Any questions that come up later on, post them in chat, in Slack. Again, been a great year for the service. The service itself has just been terrific to run, has grown like a weed, and the ideas in the service have played out really, really well. So, we'll have bad times and good times. Always happy to take the beating when we have bad times, but this year it's been a good year. So hopefully folks are benefiting that. Okay, so we'll post a recording in a couple of hours once it's compiled, and see everyone in Slack chat later on. Thanks, everyone. Speak to you soon.